But we were talking about reinsurance last time. I want to show you some charts. I can't explain these charts because I don't have the inside information. And these are charts I pull off the internet. So I wish I could actually show you real life stuff. There's no way to get rid of this guy. He is really useless. So when you have a reinsurance program, you'll notice these type of stacked bars. And what they're doing is they're showing you over here is the amount of loss. So if they were to have a $7.6 billion event, who would pay for it? So some of this is retained and some of it's shared co-insurance. Some of it they cover, somebody else covers. And so it just depends on the type of loss. So some things they have more protection than others. Like at USA, this would probably be Hawaii versus Florida or something like that. It kind of depends on what state you're in. So, and once you hit the top of this, everything else above that, they covered. They're covering some of the stuff in here. And then some of the stuff is covered by others. And then once you get above this limit, they're covering everything. So there's one I got from the internet. Here's the Allstate one I was talking about. So they retained the first 500 million, which is probably pretty small for Allstate. That's, that's a big company. 500 million is not that big of an event. And then as you go up, you start seeing different programs. Some of it might be reinsurance from a big reinsurer. Some of it could be the securitization example we're talking about. Some of it could be a state pool, like Texas and Florida and California have state pools. Texas and Florida have state wind pools. California has a state earthquake pool. So, and then they talk about reinstatement. Reinstatement is pretty important because you got to roll this thing forward. And every time you roll it forward, boy, it depends on what events you've had, what's going on in the news. So, that's a big part of this business. I don't know, it'd be interesting. Like a firm like USA, essentially it was the department of two people that did all of this. I think it would be a pretty interesting job. You'd be really specialized. You'd be dealing with some of the most sophisticated actuaries in the business because they're dealing with some pretty complex risk. So I don't know. It would be an interesting career. I don't know how often these jobs come up. If a company like USA only has two people doing this, it's unlikely you're going to see a job jump up anytime during your career. You might just kind of watch out for it. And I don't know where they came from. I would, in actuary side, there's the pricing actuaries and the reserve actuaries. They're very different jobs. The reserve actuaries, they set up the reserves, the liabilities. The pricing actuaries price the products, develop the products. I would assume the reinsurers could come from either area, but might be more reserving type actuaries. They're both actuaries. They can both do the job, but you tend to focus on one or the other. But their question is there an optimal reinsurance program? There's some way we can optimize the firm. What they're trying to do is reduce the spend. You don't want to spend a lot of money on this. You're trying to get the biggest bang here, it's not the highest net present value. Here the goal is the biggest bang in reducing the PML. That is your main thing. What can we do and spend money and get the biggest reduction in PML? And the net present value is going to be negative because you always pay more for insurance than you expect to get back. But if you can get a big drop in the PML, you don't have to hold as much capital, your return on equity goes up. There's a lot of advantages to it. So it's an extremely important job, very complex. And it's complex because the combinations of things is almost infinite, and there's so many different things you can do. So pretty cool job, pretty good specialization. So if I were an actuary, I wouldn't mind this being my entire career and just really learning this better than anybody else. It would be pretty interesting. It's not going to go away. These firms are insuring these massive events. It's not going to go away. What you could do, I think, would be interesting. Go work for Gen Re or Swiss Re for a while and then go work for State Farm or Allstate in this department, boy, that would be a pretty good career, pretty interesting. All right, so where do we go from here? So I think that essentially finishes up. We can talk a little bit about a little bit more about reinsurance. So how do you figure out the best program for reinsurance? And the way they did it at UTSA is they would run their cash models, but with different programs, different combinations, and just kind of see. You could see an application for this for AI. Couldn't you just let AI try every single combination? You tell it what you're trying to maximize. So we want to reduce the spend and reduce the PML. So whatever we can do to spend, so this one you spend $400 million, your PML comes down $4 billion. Here you do this X and it comes out. You tell the AI what you're trying to do. And you almost, there's no mathematical way to just sit down and say, optimize this. So you almost have to do it through scenarios. So that's the way to do it. Just look at the output. What's the cost of the program versus the impact on PML? It could be very, very expensive, but it eliminates a lot of risk. It might be cheap, but it doesn't really reduce much risk. And which particular scenario you have has a radically different reinsurance output. It really is pretty amazingly sensitive to exactly what event. Was it Harvey? Was it Andrew through Florida? Was it something hitting California? Every one of them has a really radically different answer. So it's a very difficult problem. So that's PML. We haven't talked about MPL. You don't hear that as much. So there's probable maximum loss and there's maximum probable loss. We won't use the MPL in our class. I don't know if they covered it on the exam. But these are calculated both on a per occurrence basis and an aggregate basis. So what's our worst PML as far as just one event? And then what's our PML for the whole year expected to be? It could be possible that the aggregate is 5 different events, and that gives you your PML, or it could be that the aggregate is just that one massive event. And depends. One scenario might be one thing. The next time you run it, it could be something radically different. So it changes all the time. So reinsurance could be a paper topic for the paper 2. I think Swiss Re. I haven't looked at Munich Re's. I doubt Berkshire Hathaway has much on their website. Swiss Re has a lot on their website, so it would be an interesting topic, especially if you're an actuary major. When you're interviewing for jobs, it's nice to have something that you've done that no other undergraduate student has done, and then find some way to kind of sneak it into an interview at some point. It's kind of a nice ad. So, find something in paper 2 that gives you that little edge that most actuary majors would not know about. Or if you're a finance major, the problem if you're a finance major and you interview a State Farm or UTSA, they're not going to ask actuarial questions. They're going to ask finance questions. But the more you know about the industry, the better, the more interesting it is. One question I got at UTSA is, what do you think is the most important issue facing us today? That question today, boy, I'd be talking risk. It's managing risk, it's understanding risk, it's measuring risk, it's mitigating risk. And then I would use, maybe the reinsurance would be my example of that. Is, boy, whoever does that right is going to survive the next major event, and just how important that is. Kind of some of the Warren Buffett things, I forget what it is built. What was his NOAA thing? It's not risk management until you build an ark or something. He said something, I don't remember what he said, but those kind of things, that's the kind of answer I would give. So your paper 2 could give you some of that stuff. All right, that's it for homeowners. We're not going to talk about the TDIs. Maybe I'll show it to you just real quickly. The TDI does have a whole section on homeowners on their website. A lot of it is similar stuff. I won't go through all of it, but just a couple of things. Most homeowners buy a policy that has 5 different coverages. We talked about that: dwellings, personal property, liability, that medical payments, and then loss of use. So you're getting 5 things. That's what we call a package policy. The insurance company, they view that as 5 different things. The actuaries view that as 5 different things. Each one of those has to be priced separately. But you as an insured, it's just one policy. You don't really notice it. Homeowners policies automatically provides $25,000 coverage. You can buy up to $1 million in coverage, but you probably wouldn't buy $1 million. You'd probably buy the standard like 300,000 or whatever, 100,000, and then you buy an umbrella policy to get you that, because the umbrella policy is so cheap. You'd probably do that. You probably wouldn't add it, because remember, if you do this $1 million, this only covers you for homeowners events. You might be more worried about your driving events. Now, if all you have is a home and you never drive, then maybe this would be the way to do it. But homeowners just cover your liabilities everywhere unless you're driving a car, essentially. So maybe it would make sense. I don't think this would make sense if you drive a car. I think you're better off just getting the standard and then buying the umbrella policy on top of that. We talked about the types of policies. 3 of the policy forms sold in Texas, A, B, and C, are standardized. This means the policy language and coverages provided are the same regardless of the company writing the policy. The A is actual cash value, and it's listed, so that's a very, very limited. HOB, replacement cost coverage. Most types of coverage except those excluded. If you live on the Gulf Coast, you might receive an endorsement that includes coverage for wind and hail damage. Most policies will not cover mold remediation beyond the most necessary. So that's the change they made, right? This is the change in language they made to really, really limit the mold. Insurance companies are required to offer you mold. This coverage will be offered in dollar or percentage up to 100% of your policy limits. Texas law requires the insurance company to pay the full amount of the policy, even if this amount is more than replacement costs. I don't remember what that means. There's an exception if fire destroyers are in this, and that comes out. I should have highlighted that. And I can't tell you if Texas is different than Florida or the other states. I don't know the 50 states. If you work in policy service or in claims, you will probably be assigned a state, and you'll learn that state extremely well. You become an expert on that state, and it does matter which state you're in. We talked about replacement costs. It's not market value. It is the cost to replace. We talked about that deductible. HOB policies automatically cover household contents, furniture, clothes, appliances up to 40%. So you're getting 40%. Obviously, you can endorse that higher. It's actual cash value on that stuff. Companies generally want you to prove that you replace an item before they'll pay your claim in full. Making an inventory will help you decide how much insurance you need. It is also simplified claims. I do this and then I don't do it for 10 years. It's kind of like a little out of date. So I don't know how you automatically do this type of inventory. Things get messy. I would get more organized and clean up more, but then I see an episode of Hoarders. I'm like, it's good enough. It's not that bad. But yeah, just going around and make a video of everything you own. Your inventory should list each item, its purchase date. That's crazy. The value and serial number. Who does that? It's absolutely crazy. Photograph or videotape each room, including closets, open drawers, storage buildings, and garage. Keep the inventory and receipts for major items in a fireproof place, or even better, if you're going to do videos, put them out on in the cloud somewhere so things get burned down. If your backup is on your computer, hurricanes and fires tend to destroy computers, so that's not all that safe. So find some better. It's kind of like I've had 2 students this week say, I lost my computer and everything on my computer is gone. I always tell students, when you're writing a paper for a class, email it to yourself every 30 minutes or an hour, just so you have it. I do that with all my stuff. I email it to myself, so at least it's out there somewhere, not in my physical location. I would do that with these type of things. Texas ranks near the top of the nation in weather-related property damage. We saw that with the mold discussion. You got the TWIA. We talked a little bit about TWIA. Ensure last resort for wind and hail coverage in 14 coastal counties and parts of Harris and Galveston Bay. When a hurricane enters the Gulf of Mexico, You can no longer purchase from TWIA. That makes some sense. There's the link to TWIA. Pays to shop around. I do believe that. I believe it much more with life insurance. I think property casualty companies are fairly competitive. I encourage, you're not going to do it every year. It is a pain to switch carriers, but at least every 5 years, and go out to the big guys, Allstate, State Farm, Farmers, USAA. If you're doing auto, Geico, and Progressive, go out. Is there an advantage of having your auto and home together? There's probably some. It's a little nice. Today with the internet, it's not that big of a deal. You do get a discount if you combine them sometimes, so that might be worth it. So you can't combine it with Geico and Progressive. But if you're in an apartment and renting, it may not matter all that much. There's probably not going to be much discount for renters insurance. So it does pay to shop around. And the nice thing is you really don't have to go beyond the 5 big players because they're pretty competitive with each other. There are differences because the actuaries in these companies have fairly different opinions. It's possible State Farm's more competitive in Bexar County than USAA, but USAA is more competitive in Travis County. So it can make a difference when you move. It can make a difference. Bexar County is pretty interesting. Bexar County has a high auto theft issue, and you can move 2 inches out of Bexar County and your rates can drop pretty dramatically. But not all companies agree on that. So the fact that we're in Bexar County in kind of a special place, yeah, you might want to shop around. And that's more auto than homeowners. I doubt homeowners is that radically different. They say choose the highest deductible you can afford. I don't know what they mean by you can afford, but I mean, essentially homeowners, you don't really get, not that many serious claims. It's on the liability side, especially on the homeowners, it's just, we don't worry about it as much on the auto side. You're getting replacement costs. So, if you have to pay $5,000 or whatever, you are getting a brand new house. So, it's kind of, it's not going to cost you as much as remodeling, and you're essentially getting it remodeled by the insurance company. So, if you have to pay it, it's not that bad. They give you some websites, helpinsureme.com. Try to help you with that. I tried the Allstate Esurance or something like that. Their website where you can compare. Progressive has a way to compare. I've tried them. It's really not as easy. The commercials make it look easy, but if you think about it, the combinations that are possible, they're just almost infinite. Deductibles and coverages and all that. It's hard to get exactly, because think about it, they're not going to go out and get prices for every single combination out there, and it's just not possible. So it's hard to get exactly what you have. So I find them a little frustrating. Texas law requires rates for insurance offered in Texas to be reasonable. Again, we've seen this: reasonable, adequate, and not excessive. Cannot be unfairly. We're going to talk a lot about unfairly discriminatory when we talk about auto insurance, because that's a much bigger issue there. Texas is a file in use. Under the systems, companies file their rates, but they do not need prior approval. If the TDI determines the company rates are excessive, they'll be ordered to pay refunds. So in some states, you have to get approval before you can charge the rate. In Texas, you file it, you go ahead and use the rate, and then Texas can come back and say, no, that's excessive. You can't do that. So here's how they're going to decide how much they're going to charge you: the age, condition of your home, the replacement costs, obviously, what construction materials are used, where you live. Some places are more dangerous than others. Availability of local fire protection, your claims history. And we're going to talk about that one. What does my credit score have to do with how much they're going to charge me for homeowners insurance? Do people with bad credit scores file more claims for homeowners than people with good credit scores? What do you think? Is it correlated or uncorrelated? Correlated, pretty highly correlated. Yeah. People with low credit scores file more claims than people with high credit scores. Why is that? Well, we'll talk about that. Does it have to do with where you live? Well, even after they adjust for that, there's still a correlation. So we're going to get into that in some detail. It's kind of a touchy topic, but that's okay. Watch out for crime, obviously. We're going to talk a little bit about this more on the auto side, but there are state plans that try to help people get insurance if they just can't get it. Surplus lines carriers are out-of-state companies not licensed in Texas, but legally eligible to sell insurance that licensed companies won't cover. Surplus lines carry generally charge more than their licensed companies. Surplus lines are not members of a guarantee association. The guarantee association in Texas is your house burns down, you got a $200,000 claim, you call the company and your company's insolvent. Then the state of Texas will step in and pay your claim once they collect money from all those surviving insurance companies. So the taxpayer is not doing it, the state of Texas is not doing it. If your company goes under, they're going to go get money from State Farm and Allstate, UTSA, and they'll pay your claim. That's the guarantee. But if you use a surplus line, just be aware that you don't have that protection. Non-renewal means a company refuses to renew your policy. A company must give you written notice at least 30 days in advance. That was what was happening during the mold crisis. Companies were just like, hey, you file a claim, we're done with you. If you move out of your house and it remains vacant for 60 days or longer, most possibly all suspend coverages for damages. So that one's a worry for me. A company cannot unfairly discriminate between individuals of the same rate class and with essentially the same risk in its rates. We're going to definitely talk about that. We're talking about credit scores. I think that might be it. Anyway, you can get that off the TDI site. They have a similar one for auto that we won't look at, but they're just trying to show you what the rules are in Texas. What they don't do is emphasize how Texas is different than other companies. All right. So let's shift to auto insurance. Auto insurance is, to me, a little bit more interesting than homeowners. It's also much more controversial. So we'll have to, and I want to show you some videos. I'm actually pretty eager to show you some of these videos. Some of them are pretty wild videos. There is one video I would like for you to watch. I got to make sure it's still available. And so I'd like you to watch it, and then I'll give you that time off from class so you can watch it, because I really want you to watch it. Very interesting video that the Institute of Highway Safety has. But let's talk auto insurance. Let's do kind of the nitty-gritty stuff of just going through the policy first. The personal auto policy, you have to first define what's covered. So obviously a vehicle that you own that's in your policy declarations, that's covered. That's kind of obvious. What if you buy a car and you forget to call your insurance company and told them you just bought a new car? Is that car covered? Your other car that you just got rid of is covered. Now you have a new car. Well, yeah, you're covered. Even though you forget to tell the insurance company you're covered. You must inform the insurance company for 30 days. If the auto acquired is in addition to declared autos, you must receive broadest coverage applying to declared autos, but ensure you got to notify the insurance company. So if you buy a second car, auto used by the insured on a temporary basis. We're talking a little bit about rental cars. This used to be a pretty bad scam. When you rented a car, they would, charge you just ridiculously high rates for auto insurance. And in some countries it's required. I know in Costa Rica, you have to buy auto insurance and you cannot use your own. It has to be a Costa Rican company. And so we rented a car in Costa Rica and we're like, wow, this is really a cheap car. And then we got the insurance. The insurance was like twice as much as the rental car. So it's like $300 for rental car and $500 for the insurance on the rental car. And it's like, yeah, you better, so I always recommend, if you're going to another country, you're going to rent a car, you should have a very long conversation with your insurance company. Am I covered? Do I need to get coverage? What am I covered for? What are the laws in that country? Mexico or Costa Rica, the laws can be really unusual. We made a mistake of going to Europe and renting a car. And that's the first time we thought about auto insurance. It's like, we might already have coverage in this, our insurance might fully cover us. Do we really need to spend hundreds, and it's expensive, hundreds of dollars on this insurance when we have insurance? And so you don't want to have that discussion when you're sitting here at the rental car place. Any trailer owned by the insured. So if you buy a car, I remember I bought a car once, a took it home and then I called my insurance company and said, I just bought this Toyota, whatever. And they said, yeah, we already have the VIN number. We already know. It's like, how do you know? I didn't tell you. So I don't know how they found that out. It's to me a little disturbing. It's like, yeah, and you also had breakfast at McDonald's yesterday. So where do you guys get this information? I don't. So somehow the person selling you cars somehow is checking that anyway for you or whatever. I don't know. Or maybe the company is somehow getting automatic reports that they're checking on. The policy itself is kind of switched from homeowners, kind of in different order. The preliminary section is essentially the same. But we start with liability. Why? Because that's the most important one. That's the one you're most worried about because we're much more dangerous in a car than we are living at home. Although I got chased by 3 dogs today on my bike by a guy who knows his dogs are pretty dangerous. So, you know, I'll be filing a liability claim with him pretty soon here. So it's covered for liability resulting from ownership, maintenance, or operation of an auto. I'm actually not going to get into this. I'm going to keep it pretty high level. I actually don't think we're going to kind of get into this a little bit when we talk about parts B and C. Most states are going to require some minimum level of liability insurance. But there's different ways that it's set up. Some have laws called financial responsibility laws. The limits may vary by state. So it's, you know, per accident for bodily injury, for property damage. Or if there's more than one person injured, you know, those are the kind of numbers you have. The numbers that state law requires can be pretty low numbers. So it's not really all that responsible to have that low of a coverage. Security type, you have to either show you have insurance or you can have other ways of showing it. Security and proof, these are kind of after the fact. You have an accident and you got to prove it at that point. That's kind of too late. And then compulsory laws, it's actually illegal to drive an auto without first having proof. Now, I don't know where the states are getting to this point of, there's been some talk that police can actually, you know, shoot something at your car and know if you have insurance, you know, some kind of system. I don't know who's got that set up yet.
We run the license plate. It
Comes up in the license plate.
confirm.
Okay.
Yeah, the thing about it, you can also call the insurance company. No one verified.
Yeah. So not having your card is not necessarily horrible because you can prove it on your phone.
Because it is a responsibility for everybody. It is for the, it's not just for you, it's also for everybody else.
Right. Yeah, I mean, that's the goal, is you don't have an accident and you're stuck with it. So compulsory laws, do compulsory laws work? There's a lot of debate on that. Studies, and this could be a good paper two topic as well. Studies that I've seen are really pretty old, but they show states with compulsory laws have a bigger problem with uninsured motorists than states without them. Does that mean they don't work, or does it mean that states with compulsory laws started off with a really big problem and it made the problem smaller, but it's still a bigger problem in other states? So a lot of studies have say it doesn't actually work, but that's the reason I think, you know, if they can check it, you know, like a military bases, not letting you in the military base unless you prove you have insurance, you know, if it makes more and more difficult for you just to go anywhere. The old idea of I'll buy insurance, get the card, and I'll cancel it immediately, that may not work as much in the digital age. So I'm not going to get into these. I used to spend a lot of time talking about no fault laws, and I just don't want to get into it because it's, you can see when I talk about Part B that I don't think is as big of an issue as it's been made. For Part A, the insured is the name insured, his or her spouse, family member who owns, maintains, or uses the car. For friends, it must be a covered auto to have the liability coverage. Any person using a covered auto, any person or organization legally responsible for the person using the covered auto. So an employee, you know, you have someone that works in your house. Any organization legally responsible for actions of the name insured. Insurers driving another car for another organization and causes loss, that organization essentially gets your coverage. Why do you get covered? Your legal costs, your bail bonds, interest, expenses, losses. Exclusions. When do you not get liability coverage? Intentional injury. damage to owned or transported property, you can't be liable to yourself. So you can say, wow, I hit the gas instead of the brake and I just plowed right into my garage. I'm going to sue myself and get a liability claim. You can't do that. Now your homeowners will cover that. The damage to your car be covered, but not under Part A, be Part D. So you have coverage, you just don't get it through the liability section. You can't file a liability claim against yourself. Injury to an employee in the course of employment and workers' comp kind of things. Things related to kind of a business, things you're doing that typically are a business. So people using your auto without permission, unusual vehicles, those that are not really designed for public roads. A lot of those may be covered by your homeowners. Is there something that falls through the crack? It's not covered by auto. It's not covered by homeowners either. I don't know. I don't own any dune buggies or anything like that, but auto owned. So you got an auto you use all the time and you don't buy insurance on it, but you have liability on another auto. You got to tell your insurance company you have that. You can't try to get liability for an extra car that you're not paying insurance for. Racing and speed contests. I don't know exactly when you're going from just being a ridiculously bad driver that, you don't want the person cutting in front of you. So you're, exactly when that becomes a racing or speeding contest. I don't know. Other provisions you'll see out of state coverage. So every state's different. So maybe Texas has a finance responsibility law that says X, Y, and Z, but then you go to Oklahoma and they're different. Are you now driving illegally in Oklahoma because their rules are more strict? Well, the way it works with your auto insurance is they say, hey, if Texas rules are not as strict as Oklahoma, the second you drive in Oklahoma, you're covered by Oklahoma's rules. So you're in compliance, will automatically adjust. Dual insurance, if you got two policies, don't think you can double dip and get paid twice. You can't do that. They're gonna work it out among themselves. Non-owned autos, that provides excess liability coverage. Insurance on non-owned pays first dollar, then insured pays. So we'll see. We talk about rental car. It is possible to get rental car insurance through like your credit card and those type of things. You should always check those kind of things, especially if you go overseas. That's one thing we found when we went to Costa Rica. There was some coverage we got simply because of what credit card we put it on. So you might check into that. Do I use my Visa, I use my MasterCard, my Bank of America card? So sometimes you do get some almost kind of free insurance. All right. So that's the liability side. We'll talk a little bit more about this when we talk just liability in general. All right, let's get into parts B and C. Now, any of y'all work in the industry? We need someone. I had a student work for State Farm last year. I told him he needs to have someone from his company come debate this. All right, B and C. I do not own B and C. I haven't owned it in decades. I think it's a waste of money. I always lose the debate every single semester. So I probably won't convince you. But wouldn't it be great if we had a debate here with someone from the industry that argue their side? I had a debate on Facebook with a personal injury lawyer. I don't know if I beat him on that debate or not, but anyway. So B and C. So first of all, how much does it cost? It's actually, when I canceled it, I put it all in A in my umbrella because I wanted liability coverage. I didn't want this. So it's a fairly significant amount. Some states require you to buy this. So you go to Colorado, you have to buy this. You don't have any choice. Texas, you don't have to. I will tell you, if you call your insurance company and cancel it, they'll make you feel like you're an idiot. You will say, I can't believe you're canceling this. I mean, this is really important insurance to have. That's what the lawyer was saying. You'd be stupid not to buy this insurance. So he's calling me stupid. So of course I replied. So, people will make you feel really bad if you cancel this insurance. So I'm not encouraging to cancel the insurance because if you cancel it, then tomorrow you'll have a claim and then you're really mad at me. So I'm just explaining to me my perspective of the frequency and severity of what B and C are covering. So B is medical payments. And C is uninsured motorists. Now, you're probably thinking, how could you not have uninsured motorist coverage? Boy, that seems like that's really, really important. We just talked about all these uninsured. So we'll talk about that. All right, let's start with medical payments. It's essentially accident insurance. And it primarily, it's like health insurance. It makes payments if you're driving your car and you get injured. It's going to cover your medical payments regardless of fault. Covers your bodily injuries and funeral costs from an accident caused by the insured. Covered while occupying auto, while driving, entering, exiting, or repairing the auto, and as a pedestrian. So you essentially get hit and run pedestrian coverage here as well. Non-insured covered only while occupying a covered auto. Some people think this is really critical, that it's irresponsible for me not to have Part B, because if I have a passenger in my car and have a wreck and they don't have health insurance, then I've caused them a lot of trouble. What would they do? They're in my car. I'm not driving very safely. I have an accident, they're hurt. I don't have medical. They don't have medical. What do? Can't they sue me on the Part A? Aren't I liable? So they could still sue me on the Part A. However, I use this to my favor. When my church says, hey, can you drive about 20 teenagers to the carnival? Say, I don't have Part B. Sorry, you're out of luck. So I use it to my favor. Sorry, I can't give you a ride. Or people ask for a ride, I can, but I don't have Part B auto insurance. So do you have health insurance or not? They have to tell me if they have health insurance or not. So I avoid it from that standpoint. But it is health insurance. Do you need this if you have a good health insurance policy? So if you don't have Part B and you have an accident and you're injured, your health insurance covers you. But if you call your health insurance company and they say you're in a car accident, they're going to say, hey, but you have auto insurance. I say, yeah, but I don't have Part B. So then it falls back on them. If you do have Part B and you have health insurance, then the two of them are going to be fighting each other who pays what. I remember a friend of mine, she was in a really serious accident. They actually had to helicopter her out. That's how serious the accident was. She had Part B, and her insurance company, health insurance company, and her auto insurance, and then the other guy's auto insurance, they're all fighting over who's going to pay her health insurance, healthcare, and none of them were paying because they're all fighting. I told her, just call your health insurance company and tell them to pay the bill because you bought health insurance. And then the other three, they can all fight it out among themselves. So you need this. If you need increased limits, so, it depends if you don't think you have enough coverage there, but, get a good health insurance policy. And then the thing I was talking about, if you're worried about non-insureds riding with you, I don't know why people don't have health insurance. You can certainly have that debate. That to me seems as irresponsible as not having liability coverage. So, people are going around. And that was the argument the lawyer made. What about people who don't have health insurance? It's like, okay, well, I could have an accident in my car, that'd be bad. They could also get injured tripping downstairs. They also could get cancer. They could also, my car driving is not their only big risk. They got a lot of risk by not having health insurance. So why is that the biggest thing they're worried about? And I think they can sue you under Part A, depending on, the nature of the risk. So it's not like they're completely uninsured. Supposedly there's no dual coverage here, but most health insurance companies don't cover it if you have Part B, so it is excluded.
Just a quick question. This is kind of if you decide to answer. So you don't have Part B and Part C on your car insurance. You don't have Part A. I imagine you have maybe good health insurance. What is your deductible?
Well, I don't care on the deductible because to me, a few $1,000s is no big deal.
Okay.
So yeah, I don't care about deductibles.
Okay.
So for some people, that might be a big deal.
Mm-hmm.
So
if you were to have an accident, then maybe it's not going to cost you around $10,000.
No, it wouldn't be that much, but it might be 3,000. Yeah.
3,000.
Yeah, which is not a big deal. It's like we're talking about something extremely rare, right? It's extremely unlikely to happen. I'm more worried about cancer or heart disease and those kind of things than an auto accident kind of thing. But So if I'm worried about that deductible, I'm worried about it with those other things. I'm not like, man, cancer's not likely, heart disease not likely, but man, I could have an auto accident, get injured. No, that's not my biggest health concern out there. I think I have much higher risk things out there than those things. So that's my issue, is why it is in a car suddenly this big event where you have that exact same risk everywhere else with health insurance. It's no different in a car.
Is there a way that your company can figure out that you don't have something?
I don't know how they would ask that. Yeah, I've never heard that before. Yeah.
Or maybe discount?
And it's still not that, how many people that are, from auto accident, it's not that frequent of an event. There's much more, especially when we get to part C, we're going to talk about that. There are people who get hit by uninsured motorists. I'm talking people getting hit by uninsured motorists, and it's serious medical issues. It's not as common as many other things I can mention that people aren't insured. And that's kind of my issue, is this is a risk that exists in many other places that are actually more frequent. And no one's worried about those, but for some reason, when you're sitting in the car, you're supposed to make this high priority. You got to get this thing insured. It's like, no, to me, it's inconsistent. You have the risk in 90 places and you're really worried about it in one place and you're ignoring the other 89. It's like, it doesn't make sense to me. So this, somebody would comment. So I don't have part B because I have health insurance. I don't care about deductibles, but yeah, if you have really high deductibles, then yeah, this would cover you probably better than your health insurance. Probably the bigger controversial one is uninsured motorists. So as we say, some of these studies say they don't work. In all states, uninsured motorists, about 15% of drivers. In states with compulsory laws, it's about 20%. That may be changing though now in the digital age. So what's an uninsured motorist? The other driver is at fault and they don't have the liability coverage. It could be hit and run, so you don't even know who the other driver is. There's a lady at my church who was in her 70s, had a hit and run, and she's out in the middle of the country and didn't know who hit her, and her car is disabled. Called the police. It took the police hours to get there, which just infuriates me. This sweet little lady's sitting out in the middle of nowhere, and it takes them forever to get out to her. She had this coverage. It covered her rental car and did some things. She was glad she had it. It did help her, but it was hit and run. So even if the person who hit her had insurance, it didn't matter because she had no way of proving who they were or even figuring that out. Or your insurance company denies coverage or become insolvent. The insurance company of the other person, are their limits or just not what you need? Underinsured motorist is one who has what the state requires, but it's not enough to cover your losses. Then this will make up that difference. So they are insured, they have insurance, but they have $30,000 and you have a $50,000 in losses, then this will help out in that case. Most states require it to be offered and you must be turned down. Some states actually require it. I remember when I canceled it from UTSA, they were like, man, you're an idiot to cancel this. And every time they say you're an idiot, I'm saying, okay, walk through the scenario where I'm in a lot of trouble. They never come up with one that where I'm going to tell you the one thing students say, no, that's important to me. And I look at it and say, I don't care about that. So that's probably why you're going to disagree with me. What does it cover? Bodily injury, medical costs, lost wages. Coverage is only for compensatory damages. So you can't get punitive damages, and so here's the key. Part of compensatory damages is pain and suffering. So if you don't have part C, you will not get compensated for pain and suffering. I do not care about pain and suffering. It's not important to me. If I'm in pain, give me $100,000 does not make me happy. I just don't care. I got plenty of money, giving me more money and say, hey, you're going to be in serious, horrible, horrendous pain the rest of your life, but here's $100,000 to make up for it. It's like, no, I don't care. I don't want the pain. If you can't get rid of the pain, giving me money doesn't help. Some people, I had one lady in the class say, I said, what if you're going to be excruciating pain the rest of your life, but they're gonna give you $1 million. And it's like, yeah, that sounds good. I would do that. It's like, you would do that? Excruciating pain the rest of your life for $1 million? I just, it doesn't make sense to me. So that may be the thing that, I want that pain and suffering. I mean, I don't want the pain and suffering, but I want the money for the pain and suffering. And that was the thing the lawyer talked about. You don't get, if you don't have this coverage and you're in a lot of pain, you're not going to get any compensation for that. I don't know, pay my medical bills through my health insurance. I'm with that. Property damage is an issue, and there are some deductible issues here, but you're still covered by Part D in this part. You just got your deductible and other things. The issue I had with my old Prius when it was 13 years old, I canceled Part B as well, a D as well. So I didn't have any Part D. So if I'd gotten hit by an uninsured motorist then, my car just would have been totaled, but I had that risk anyway if I had done the accident. So if you have Part D, you do have the property damage. So you don't have to say, wow, what happens if I get hit by an uninsured motorist and they total my car? Well, your Part D will cover that after the deductible. So you do have that coverage. You're not getting any coverage from your uninsured if at-fault driver has greater coverage. So there are some rules about, hey, you weren't adequately covered, and the other driver is better. They're not going to make up that difference because you should have had more. So there are some issues they have here. I'm not going to read these other things here. So I don't have it. It's primarily, overwhelmingly, this is health insurance as well. So B and C are overwhelmingly health insurance. We'll talk about some other things it covers here. Pain and suffering is the biggest one. Funeral costs, and there's some other things it covers that you may not have coverage for. Disability is another one, but I have, to me, disability insurance is not important because I'm retired. UTSA pays me so little, it's not something I think about. So there are things you think about. You don't have disability insurance, this will provide disability insurance. But again, it gets back to my point. If you don't have disability insurance, is an auto accident with uninsured motorist the only thing that's going to make you disabled? Aren't there another 89 things that will as well? And if you're worried about it with an auto accident, why aren't you worried about it with the other 89? So that argument just doesn't hold up for me. So the solution some have gone to is, let's forget about uninsured entirely. Let's go no fault. What this means, theoretically, it doesn't work like this, but what it means is two people have an accident. Your insurance company pays all of your costs. Their insurance company pays all of theirs. If they're not insured, they get nothing. And that's the theory. Seems perfect, right? So you don't care if they have insurance or not. Your company just covers you. And they don't get anything from you, even if you're at fault. Even if you cause the accident, if they don't have insurance, they're out of luck and you're covered. Right? So that sounds like that would completely eliminate the issue. But then people say, yeah, but what about these really egregious cases? We can't let this person get off on that. We got to have, so then states say, okay, well, it's no fault unless the loss is over X dollars. Well, if that X dollars is $100,000, then it's going to be really effective, right? Almost everything's going to be covered no fault. But if the excess is $1,000, what happens? Well, what they discovered is the excess is really low, and you have a claim, and the excess is $1,000, and your claim's $990. What are you going to do? You're going to inflate that claim to get over 1,000, so you get this coverage. So what they discovered, if the threshold's too low, no fault was actually increasing the claims because people were pushing it over the threshold. So even that didn't work. So it's the biggest argument for no fault is that the biggest winner of all of this are attorneys. And when you do no fault insurance, you no longer need the attorneys. You don't have to have anyone figure out who's at fault, who's liable, who's suing whom. Everybody's just covered by their own insurers. You get the lawyers out. If you get the lawyers out, you really are cutting a large portion of the cost. Guess who's the biggest group that opposes no fault laws? It's trial lawyers. It's personal injury lawyers. They hate these things. And what they discovered is small claims especially get overpaid because the insurers don't want litigation, and it's the largest, most flagrant claims that are getting underpaid because that's what everybody fights. And so with no fault, you fix that. So no fault, really, when it was being touted, even at the federal level, was viewed as a form of tort reform. Let's get all these legal costs out of the system. Let's just, you buy insurance, you're covered. So what they're trying to do is get more equitable distribution so accident victims get what they really need, and it should reduce insurance premiums. My issue is the main thing we're talking about here again is health insurance, which I already have. We're not talking about property insurance, so we're mainly talking. So I really don't see the big issue with that either. But all right, so I don't have parts B and C. I'm going to come back to this, and I want to cover B and C a little bit more. And I have out there on your Blackboard this part B and C debate. And I added to it, I think I added to it, the lawyer debate I had on Facebook. We'll see if I did or not. So I think it's all the internet. It's real easy to find people arguing for parts B and C. They're all over the place. Just type in Google, should I buy parts B and C auto insurance? And probably 98% of them are going to say, absolutely, you should. And 2% of them are probably stuff from my class. Your financial losses would include medical expenses. Okay, so it's health insurance. If you have health insurance, you're double paying for health insurance. You're paying for it through this policy, and you're paying it. And I have a strong opinion. Health insurance should cover health insurance, and nothing else should cover health insurance. You should buy health insurance for one person and never pay for it anywhere else. You shouldn't have workers' comp. You shouldn't have auto. You should just have homeowners. Remember, there's a little bit of medical and homeowners. Health insurance should cover medical expenses. Disability income, loss of income. If you don't have disability income, this policy provides protection, but only if you're in an auto accident. Sorry, I keep repeating this. If you need disability income insurance, you need disability income insurance. This policy does not provide that, except in the limited case of you getting hit by uninsured motorists. That's the only time it covers you. Seems illogical to me. Any diminution in your ability to earn money, that's disability. Household and related help and assistance. So you can no longer clean your house. You get someone to clean your house. I can self-insure that with no problem. You need someone to come in and take care of your kids. I've got a cat. He's on his own. I'm seriously injured. My neighbor takes better care of him than I do anyway. You have to think about those things. So you go through the scenarios. What could go wrong? And then pain and suffering. That's the one I've just decided to give up on. And you want to argue pain and suffering is really, really important? Is that critical to you? You absolutely want that covered. That's the one I think is the biggest one. Even if you don't have disability income, I still think this is the biggest one because you either need it or you don't, and you shouldn't just buy it just for auto. So this one was interesting to me. The gray area is mine. This one, he's proving that you need to buy this. And he's proven it because he had a claim. Right? That's like someone saying, you better buy lottery tickets because I won the lottery last week. Does that sound like a good argument to you? Sounds like he was really lucky. So if you know for sure you're going to have a Part B and C claim, if you're 100% sure, yeah, buy the coverage. If you know you're going to have a claim, buy the coverage. If you know you're going to die, buy life insurance. If you know you're going to have a heart attack, buy health insurance. That's pretty obvious. Unless the insurance company knows it as well, then you can't buy it. We are talking about very low frequency events. So proving something happened is not proof that you should get this. So of course, the claim triggered my collision deductible. So it pays $500 deductible. I should have highlighted that one. The deductibles is an issue here. It was going to be counted as a not at fault claim by my insurer, which inevitably would raise my rates. He says it's going to raise your rates. Even though the accident was not my fault, I actually somewhat question if that's true. Here's where the beauty of uninsured motorist comes in. Since I had the coverage and filed the police report showing the damage was the result of hit and run accident, my uninsured motorist coverage was triggered rather than my OTC. Yeah, you know, collision parts D. Yeah, he's worried about the part D coverage and that's going to raise his rates. It shouldn't. If he's not at fault, it shouldn't raise his rates. But the uninsured motorist coverage works differently. First, my deductible was reduced to $250, so it saved him $250. Remember what we said? Insurance is what kind of risk? Low frequency, high severity. Have we gotten to high severity yet? $250 doesn't sound like it. It would not be counted against me in a form of additional premium. I still don't think that's the case, but maybe he's kind of guessing that. This is a prime example, as with all insurance, of why it's a good idea to get as much coverage as possible. What did I say early in the class? You don't want as much coverage as possible. Remember, with insurance, always important. Every insurance transaction is a negative net present value transaction. Every insurance transaction is priced for you to lose money, or it wouldn't work. Every once in a while, you're lucky and you have a serious accident and you make more money than you paid in insurance, but on average, you're going to pay more for the insurance you're going to receive. So you shouldn't buy as much coverage as possible. Without uninsured motorist coverage, I would have been on the hook for more than twice. He would have cost him an extra $250. And maybe, he kept arguing, maybe higher premiums because I had a claim under Part D. This guy, you know, over his lifetime is probably going to pay more than $250 for that coverage, or his Part C coverage. He's probably, even with this claim, going to come out behind. You know, this is costing him $50-60 a year. You know, 5 years, he's going to pay it all back. So remember this, next time anyone tries to tell you uninsured motorist coverage is unnecessary if you have physical damage coverage on your vehicle. You never know when you will come out of a grocery store and find your door smashed and no note left. So pay that $60 a year for the next 20 years, and you might save $250. Not a strong argument in my opinion, but that's his argument. Uninsured motorist protection can help you in another way. Let's say you're a pedestrian. You carry this coverage, you get hit by a car while you're trying to cross the street. This coverage will pay your medical expenses. Again, it's health insurance. And lost wages. Again, it's health insurance and disability insurance. So, hey, I don't have health insurance, but at least if I cross the street and get hit by a car, I'll be covered. I don't worry about health coverage any other time in my life. If you switch jobs, you could lose your health insurance. That's true. I would recommend if you switch jobs, you make sure you don't lose your health insurance, that you get that covered on the way out. And then other people traveling in your cars, or your family members traveling in other cars, you probably can't afford to drive without it. Why? I haven't seen anything in here that concerns me. I have health insurance. I don't care about disability insurance. But if I worked at UTSA, I would have plenty of disability insurance through them as my employer. I might have disability through UTSA. I don't know. I actually don't think about it. Here's another example. This is a very common question we encounter. I've heard of insurance agents who express opinion people do not need this coverage if they have health insurance. Unfortunately, this reasoning fails to take into consideration all the other benefits. So he's saying, okay, I'll give you the health insurance argument, but there's a lot of other stuff this stuff covers. So let's see what those others are. What I love about his list is he's like, my list is what covers clothes. It also covers shoes. It also covers shirts, and it covers pants too. And it covers short pants too. And it covers long. It's like he has the same thing listed like 4 times just to make his list as long as he can. So it covers pain and suffering, disability, scarring, disfigurement, mental anguish. What is mental anguish? That's part of pain and suffering. Loss of enjoyment in life. Not only does it cover pain and suffering, it also covers loss of enjoyment in life. Those are the same things. Loss of earnings and earnings capacity. That's disability. He keeps covering the same thing. As well as unpaid medical expenses. He just mentioned that up there. He says all the other benefits. The other benefits besides health insurance includes medical expenses. Well, that's health insurance. Incurred in the past and those incurred in the future. That's not all that list. What's the only thing in that list that we haven't already talked about is pain and suffering. Scarring, disfigurement, that's part of pain and suffering to me. It's all those things that make life miserable that somehow getting some money is going to make all right. Of this list of items, the ones which you would covered by health insurance maybe would be covered medical expenses beyond having their medical expenses. Someone carrying no insurance who's struck by uninsured driver would receive no compensation for all this long list of stuff. So to me, it comes down to if you have disability medical insurance, pain and suffering is the only thing on that list. Every day throughout Florida, hundreds of people are seriously injured who also believed it would never happen to them. What are the actual numbers? That'd be good. That'd be a good paper two topic. How many people are actually seriously injured where the other driver was uninsured? Now remember, they have health insurance, a lot of that's covered, they have disability, a lot is covered. So what actually is the coverage that people are losing? Is it really that serious? The injured person will immediately begin to consider who will compensate them for substantial losses they have incurred. Losses such as, well, here he goes again. In the more serious accident, all of those may be incurred, particularly those involve the death of a loved one. People naturally become angry and frustrated when they've been struck, only discover their own policy insurance that include uninsured motorist coverage. If there is any liability coverage available to provide compensation for injuries, even though it may be woefully inadequate, Medicare and virtually all health policies have reimbursement rights. Big deal. So they're going to go out and get their money back. Big deal. I got covered. The fact that I couldn't double dip and get excess coverage, I'm not buying insurance to win the lottery. I'm buying insurance to cover my expenses. So I'm fine with that. I would love to talk about the Walmart case, and I do need to get the Walmart case here. One thing that's pretty incredible here, and I didn't bring up the lawyer because it would have been too touchy, is one reason people need this stuff is because the lawyers take so much of the benefit. The Walmart case is an incredibly interesting one. A lady was hit by a truck and very seriously injured. And so they sued the truck driver. And for some reason, her lawyers didn't get enough compensation to cover her. But they got compensation. And then Walmart says, but your compensation was for medical bills and we paid your medical bills, so that money belongs to us. And Walmart got really bad press for going after this lady, which Walmart probably should have just dropped it. But Walmart's argument was our health policy requires us to do it. We have no choice. We're stealing from the other employees if we don't. Now, they probably should have found some way to get around it. But when you read that story, the shocking thing to me, that story wasn't Walmart. It was how much of the money that got paid from the truckers went through her lawyers. The bulk of it went through her lawyers, and she ended up with very little money. And her lawyers, to me, didn't do a very good job because they didn't get enough money to pay all of her compensation. It's an interesting case. But yeah, it is true. Health insurance companies do have the right to go after, and they can get that money because that's what their policy says. The only way someone may protect themselves is to carry the maximum amount of uninsured motorist coverage they can afford. Does that make sense? Did you buy the maximum you could afford? So, okay, I cut out Starbucks. Maybe I can wear these shoes for another 3 years. This car might last another 10 years. I can sell the house, move into a shack. I'm going to put all my money on Part C insurance, the most I can possibly afford. That does not make sense. The argument I have with my lawyer friend is because he's arguing, well, people may not have health insurance.
Say, well, it's the smartest thing for them to do is to buy Part C to get some health coverage only when they're in a car accident. Maybe they should take that premium and buy health insurance. Or maybe they should take that premium and buy life insurance. So here's the statistics. What's more likely, you get hit by uninsured motorists and you're seriously physically hurt, or that you suffer premature death? I'd like to see the statistics on that. I would venture, I know far more people whose families have suffered premature death than people who have serious medical issues because of uninsured motorists. I don't know the statistics, but I think a lot of people would be better off taking Part C and buying life insurance than they would be using. So the issue is, don't buy the coverage the most you can afford. You need to allocate your insurance for where those high severity, low frequency events are, where you get the most bang for the buck. And I don't think C is the place. But, and again, if they don't have health insurance, then maybe they should buy at least some minor health insurance policy with the premium they're paying here, that at least give them some coverage for other things besides an auto accident. All right, I'll finish up with this last one and we'll get out of here. And then Thursday, you can come back and debate why you think you should buy B and C, because I'm sure I haven't convinced any of y'all. I also believe, and you can correct me on this, that over half the people in this room right now don't know if they have B and C. Is that true? People here have no idea if they own it, huh? You have C but not B. All right.
What's the name of the policy?
I'm sorry?
What are they called? Because I was just in my insurance and I was trying to see what I was paying.
She's uninsured.
Oh, I have to go.
Yeah. You'll see it as medical and uninsured motors. Yeah. And then look what the premium is. If the premium is $2 a year, no big deal. If it's 100 and something, I forget what mine was. I might have it in my notes. It was a sizable amount that I could buy several $100,000 of liability coverage, which is something I do worry about. I do worry about turning right and hitting a bus full of 40 kids in it and wiping me out. You know, so I worry more about that than I might have to pay an extra $250 for a deductible. All right, we'll start here next time. All right, let's finish up auto insurance here as far as the policy itself. Any of y'all go and check your Part B and C and see what you had? Any surprises? So there's two things. Most people don't know if they have it or not. And then obviously if they don't know if they have it or not, they don't know how much they're spending on it. You know, you should never buy insurance if you don't know what you're spending for it, because there's always a cost benefit with this. But the last argument, this one's just for the medical payments only. If you already have sufficient health, life, or short-term disability, consider eliminating and purchase decreased amounts of medical coverage from your auto insurance. Keep in mind that unlike your health coverage, medical payments coverage is not generally part of an HMO PPO and may provide greater flexibility in care. So they're saying may provide, you know, it gets down to the frequency and severity is the worst case. So this is the argument. If you want to call your insurance company, it's like I just said in my previous class, go to the extremes. Tell me the extreme scenario where I'm going to say, boy, I really wish I had this insurance. If that's $500, $1,000, like, it's not worth it. If it's $84,000, then, you know, maybe it's worth it. So what is the worst case scenario? I think the worst case scenario for Part C is you don't get pain and suffering. I mean, that could be hundreds of thousands of dollars. I'm saying I don't care about that. So is this just covering something that's low frequency, low severity? You can handle it. It's a few $100s. It's not gonna break you. So, all right. So that's that part of the policy. Related to that, uninsured, is the insurance industry says there are some people who are just not insurable. They're horrible drivers. They're unreliable. They don't pay their premiums. And a lot of them are going to be uninsured because they can't buy insurance. And so the state says, you know what we'll do is we'll find a way to get these horrible drivers on the road, because they need to get their jobs. Yet we're spending millions of dollars providing public transportation, but they shouldn't have to take a bus. I know they have accidents all the time. They're really risky, but we've got to get these people on the road. I'm going to show you a few videos of those people here, maybe next week. So the insurance industry says we can't afford it. We got to charge them, $1,500, and they can't afford that. So the state says, okay, well, we're going to call these people a residual market. This is the market that can't find insurance. So how can we find a way to get them money and we get them insurance? And so there's a few plans. There's assigned risk plans, reinsurance facilities, joint underwriting associations. They're all very similar. Essentially what the state does is they say, if you've been rejected for insurance or you just absolutely can't afford it, it's just way too highly priced, come to this state pool and we'll give you a price. It'll be higher than what the average driver gets, but much lower than what you can get. We'll give you that insurance, and then we're going to assign it to another insurance company. Or we're going to give it to another insurance company, or we're going to write the insurance, and the insurance industry is going to come back as our reinsurer. So if we have any losses, it won't go to the taxpayer, it goes to the industry. Joint underwriting associations. So essentially what they're doing is they're subsidizing, not with taxpayer money, but with your insurance premium. You're paying more for insurance in order to subsidize these people because they're being undercharged for insurance. So if your risk is unacceptable, if you're too dangerous, the state says we're there for you. We'll keep you on the street. There's one driver I want you to see. I'm going to create this video. It was on that TV show, Canada's Worst Drivers. If you haven't watched that, it's a really good program. And I'm going to show you this one driver. My thought was, this is exaggerated. There's no way there's a person like this out there. And then a couple of days later, that person was right next to me. So we'll talk about the kind of bad drivers out there. Is it really in our best interest to do whatever we can to keep these people on the road? Are there other solutions? Can they really not take the bus to work and those kind of things? So, it's an interesting debate, but a lot of people think, driving is really, really important, especially if someone needs to get to work, got to pay, take care of their family. We got to find somebody to get them insurance. And we'll talk about credit scores and how that exacerbates all of that. Part D is damage to your auto, collision, and other. So other than collision, OTC or collision. Collision is the upset of a covered auto or non-owned auto, so it includes your own cars, or its impact with another vehicle or object. And then other than collision is just comprehension. It's just everything else besides an accident. A non-owned vehicle is unique. Auto not owned or permits are available for regular use. You can't have a car to use all the time. So right now, my brother is using my mom's car because she can't drive anymore. I actually wanted to sell it because used car prices were so high and it was a really nice car. And he's like, yeah, I kind of need it. I was like, okay. But so I was kind of like, yeah, I can see it. It is a nice car. It really is. He's paying for it, but he's having to pay the insurance because he can't just rely on my mom's insurance because he's the one really driving the thing. So, but if it's a rental car, you're using irregularly, you borrow your neighbor's car, those kind of things are still covered. So you don't want to get it that you're using cars so much and you just want to save money on insurance and just say, hey, it's a non-owned auto that I'm using. If you're using it all the time, you're going to have to buy insurance on it. Exclusions, damage due to wear and tear, freezing, mechanical or electrical. So auto insurance is not a warranty. I know Heather calls you all the time, right? That your auto warranty may be expired. Has she called you yet? She calls me every week. That's not what auto insurance is. It's not a warranty for damage. What is due and confined to? So let's say you have a mechanical problem and you have a collision. The collision causes more damage to that. They're probably going to have to repair that because they can't tell what caused the damage between your lack of maintenance and the crash. You are getting actual cash value, so you're not getting a brand new car. So you're not, if you have an accident, it doesn't mean you suddenly replace the entire car with brand new stuff. You can get enough money to buy another used car. If you owe money on the car to a bank, the insurance company is going to pay them first. They're not going to pay you. Equipment in the car is not covered unless it's attached to the car. So you have golf clubs in the back of the car, those kind of things. Your homeowners is going to cover that, not your auto insurance. So I had my car, made a stupid mistake. I left my bike in the back of my car. I get up the next morning, there's this glass everywhere. They'd broken out the back window, take my bike out. They did it out the back window because they didn't want to set the alarm off. My car deductible, I had completely eliminated Part D because the car was 13 years old. But I had a homeowner's insurance, and homeowners covered the bike. And I was shocked how they covered the bike. I hope I didn't tell you all this story already, but I bought a $1,200 bike, and it had some mechanical problem, and the manufacturer didn't have that bike in the shop, so they replaced it with a $2,000 bike, and that was one that was stolen. So I told USAA, a bike I paid $1,200 for, but is worth $2,000 was stolen. What do you think they gave me? 2,000 or 1,200? 2,000. Yeah, they gave me 2,000. I was like, so I was perfectly honest with them. You know, I probably could have said 3,000. They didn't question me. They didn't ask for any evidence whatsoever. I told them 2,000 because that's what the bike people told me. So it's like, so I got a brand new $2,000 car out of it, but also had a broken window I had to go get fixed. It made me really mad. That's when I thought about the Apple little things, whatever you call them, the you know, find stuff anywhere kind of thing, if that would be worth it. You're getting what? Hacked. Yeah, there's been some issues with them, and what I heard, it was a little creepier, is people putting them on a person and not telling them so they could track them. That sounds a little even scarier. I don't know if that's the same as hacking, but I saw a news article where people were like, yeah, you got one of those under your car. Someone's tracking your every move. Some ex-spouse or something is like, I want to know where this person's going. So that's kind of scary. But I would have loved it to have been on that car, on my bike that morning, and drive up and say, hey, you have my bike, return it, please. I did call the police, and they didn't care. They weren't going to go look for it or anything. So, I mean, you're just going to lose it in that case. So what do you get? This is pretty important. You get actual cash value, something similar, you know, the Kelly book, Blue Book. I don't know how Kelly Blue Book is today with used car prices up so much. I don't know how current they are. Yeah, I wonder about that with mine. I bought mine used. It was a 2019 Toyota Prius Prime. I don't know why they need my zip code, but where do they give the price? Get my car value continued. No, I was supposed to say no thanks, right? Oh, sorry. Mileage. I mean, it's ridiculous, right? We're not driving. I bought a used car 2.5 years ago and it has 7,000 miles on it. Oh my word, come on. Why don't I care about the color? A gray car is better. All right, so yeah, I don't know what they're doing. So anyway, you can go through and figure out what the value is. They're not going to tell me. Yeah, it's just very good, excellent. Yeah. I'll probably I love the ones that say we'll email it to you later. It's like, give me a break. Anyway, it's an ad. Yeah, they're never going to tell me here. There you go. Yeah, that's about what I paid for it three years ago. It's probably fairly accurate. I mean, it looks like they are adjusting for the rise in car prices. Insurance company, you know, is probably using something similar to this. It's probably very similar, you know, because insurance companies are going to outsource that anyway. So, you know, that's what you're going to get. They're not going to give you a brand new car. Now, I know there's advertisements out there for replacement costs. Liberty Mutual is the one you see the commercials for. If you actually read it in detail, you'll discover it's not as wonderful as you might think. You're obviously going to pay for it. I can't find any, but you can read and see that it's not quite as good as it sounds in commercials. Obviously, if you did that, if you provided extra replacement costs, a brand new car, the moral hazard of that, who has a 7-year-old car, they don't want it to get stolen and get a brand new car. I mean, that's just anybody. So there's obviously Liberty Mutual is not giving you a brand new car for a 7-year-old car without either charging a whole lot or a lot of caveats. And you read the caveats, you discover it's not as good as it sounds. So they give you actual cash value, cost of repair. They have coordinated benefits, so they're not going to let you, have the same insurance from 3 different companies and they all pay. If you have renter's insurance and you rent a car and your insurance company has coverage, but you also buy the rental coverage from the rental insurance company, the rental car company is going to be the coverage that you're going to have. So, as your cars get older, that's why, when I hit, I think it was at 11 years, I just canceled Part D entirely. I said, forget it. Who cares? If I crash it, I'll go get a new car. It just wasn't worth insuring it. Even though insurance is really low because the car was so old, it's like, why even bother with it? If you have an unclaimed, you got to tell the insurer, obviously, you got to submit proof of loss. You probably have to call the police and get some kind of police report, some kind of documentation. You need to protect the property, just like we did with homeowners, and notify the police. It's not fun. Have any of y'all notified the police to get a police? It's pretty. I don't know whoever is on the other line does not like that job.
Yeah.
That guy was like, you're wasting my time. I'm really bored with this job. I had asked him to repeat something. I couldn't understand it. Oh my word, that was the worst thing. I was apologizing. I'm so sorry I have to call you. Someone stole my car. He did not like that job. All right, Part F, general provision. Insurance companies have the right to subrogate. So you got to be really, really careful. This is one of the reasons why it's really, really dangerous for you to say, just give me $100 and we'll call it even. And then you get home and you find something else going on. If you try to negotiate something with the other party, you're greatly jeopardizing your insurance. I had a friend, someone hit him, wasn't paying attention. And this guy was like, hey, I'll just give you $50. I really don't want to call my insurance company. And my friend did it just right. He says, no, we're going to file a claim. I'm going to do it by the book. And the guy was really mad. It's going to make my rates go up. He says, yeah, well, you shouldn't have hit me then. We're going to follow the rules here. There are territory issues, which I say anytime you drive anywhere outside of the United States, always call your insurance company, have a lengthy discussion. I had a friend in the military. He got stationed in Saudi Arabia. They told him, don't bring a car and don't bring your wife. So he brought a car and he brought his wife and 2 daughters. And then he called me and says, auto insurance is illegal in Saudi Arabia. What do I do? I said, yeah, I don't know what you do. You should have thought about that before you shipped your car over there. But yeah, there are some countries that can consider insurance to be an ethical and moral thing. And he essentially had to go driving a car without insurance. You do have some endorsements, extended transportation expense coverage when you need to rent something, your car is out of hock for a few days. Towing and labor, not that expensive. You got to remember it's towing and labor for a covered event. So you have to, it's not just, mechanical kind of failure. And then you have what we talked about before, you're somewhat automatically covered by the other state's rules when you go into another state. So you don't have to worry about, buying a special product just for each state, but you don't have that when you go to other countries. So always be careful on that. Here's my Part B and C. $200 or $122, excuse me. 70 and 51, 70 for, so $122, so about $10 a month. I could buy a lot of liability insurance for $122. So I decided to get rid of it and just buy the liability insurance. I don't know if any of y'all price it. I don't know if it's more expensive for younger drivers versus older drivers, or how much how this product actually differentiates between different types of drivers. But 122 bucks. It wasn't that's a lot of money, I can't afford it. My question is always, could I spend the 122 bucks in a better way? Is there better insurance than for this? And I thought there was. I thought liability insurance was a far better one. But go price it. USAA's website is really great. They let you just click on things, look at the price, and then they ask you, do you actually want to execute that or not? I could just in a few minutes see how much each section. What if I increase my liability? What if I increase my deductible on Part D? That's where I got the numbers where I was showing you right online. I just did different scenarios: $100, $500, $1,000. What's the difference in the different deductibles? So you should know that. You know, how much am I paying for this particular coverage, and then think worst case. If your worst case here, ignoring pain and suffering, if your worst case here is maybe, you know, $500 or something, it's probably not worth it to pay $122 for the outside risk that you might suffer a $500 loss. It's just, we saw that one guy in the article, he was so happy he had this insurance because it saved him 250 bucks. Well, with my coverage, he would have lost it in 2 years. Wouldn't have covered him all that well. All right. We'll probably do some videos now. Let's make sure everybody's clear on the exam, right? That's pretty important. I thought my risk management class was pretty obvious, but had students afterwards like, we don't have a clue what we're supposed to do in this exam. Wow, I didn't realize that. So here's your exam guide. Just one last time through it. Any questions on any of these? The CAPM question, you got the rubric, you got the pieces. Is there anything on that rubric you're like, I don't have a clue what you mean by that? No, they'll be due at the beginning of the exam on Blackboard. You submit them. Yeah. I'll set that up this weekend, but yeah, so they're open book. I mean, I thought open book would make the grades go much higher, but they're exactly the same. There was no change whatsoever. So yeah, what some students do is like, I have no earthly idea what that means. Let me make something up for the exam and see how I do. I don't understand that. Let me call the professor and ask what that means. Would that be more logical? I have no clue what to do on this question. Let me call the professor. Some students is like, well, he might think I'm stupid. Well, I might think that while I'm grading your exam, not that you're stupid, you know the answer, that you weren't smart enough to call me and ask me for input. That would be smarter to me. My logic is, if you don't know the answer, call the professor and ask him. I'm on a bike, probably not in the mornings because it's too cold, but I'll be on the bike the next 2 afternoons, maybe only 3 or 4 hours this time because it's been cold, but you know, give me a call. I will definitely talk to you. If you email me your answer, I'm going to give you a very high level, very fast review because I have 100 papers to grade this weekend. So I will not email you back detailed. I might say, well, you're really missing it on this thing, you know, look back at the notes or something like that, but I don't have time to grade exams twice. All right, so no one's saying anything, so hopefully you know all of those. The second one on the mold, anything in there? Storm surge is really the weakest part for most students, is understanding what I'm looking for there. I'm not saying storm surge was just like mold. I'm saying the court case was trying to treat storm surge just like they did with mold, to reinterpret that storm surge was covered, but the insurance industry won that argument. They've never had to cover storm surge. So my argument is it was close. It went to court, it was being challenged. There were some pretty big heavyweights, especially in Congress, on the side to reinterpret the contracts. But in the end, the insurance industry won. But if they had lost on that, it would have been far worse than the mold issue. You notice, anybody notice the biggest number here? Right there. I have students that completely miss that part of it. This is the whole reason we're doing this. Mold and storm surge. Actuaries price policies assuming certain frequencies and severities, assuming certain wording interpretations, and the courts reinterpret that such that you're insuring something that has much higher frequency or much higher severity, such in the case of mold, completely disrupts the entire pricing equation, they have no choice other than raise their prices or get out of the markets. That's really key here. Now, that's kind of part here. Insurers threaten to leave the market. That's kind of part of that, but that's really important here. It's 30% of the answer, and some students don't even talk about it at all in their answer. So make sure you have that in there. The PM output questions should be pretty simple. Did y'all write down which class we did it in? I can't remember. I have all the videos for the class have an index, so you'll find it if you go through all the videos. I can't remember when we did it. Yeah, Jennifer, I'll put the questions, the 2 essay questions will be out there this weekend. These last 2 questions you'll take in class, closed book. Everybody make sure you know that, right? These last 2 are closed book in class, the math questions. So the first 2 you'll submit by 9 o'clock on exam night, which I think is next Thursday, right? March 1st. So these 2 you'll submit on Blackboard at 9 o'clock. By 9 o'clock, I'll have them out there before the end of this weekend. These 2 you'll take in class. So next Thursday's class will be pretty short because all you're going to do is take the 2 math problems. And this one does have a tutorial. A lot of students do really badly on this question, and it looks exactly like the example. I just changed the numbers, so I'm not really sure on that. So realize that it is closed book, no formula sheets, so you just have to plug in the numbers. But I mean, if you want more problems, I guess I could give you more problems, but I don't have. I'll look, maybe I'll give you last year's question, and I'll find a student who got 100 on it and give you their answer, and maybe I'll do that. We'll see. If I forget, you can email me, maybe I'll remember to do it. But it's gonna be exactly the same thing over and over again. We did 2 problems in class, so you have those 2 problems as well on the video to look at. So you really have 3 problems, although one of the problems within in class might be the one that's in the tutorial. All right, so there's the exam. At 75 minutes. This says 20 minutes, not because you only have 20 minutes to answer it. If you want to take 6 weeks to answer it, you'd have to start 6 weeks ago. But if you want to take 12 hours to answer it, that's your choice. That's just how much it's worth on the exam. It's worth 20 out of 75 minutes. So that's its weight in the exam. I weight my exams just like they do the CFA exam. It's weighted in minutes. I'm not hearing any questions.
Well, the first one, I'm not really sure.
Yeah, the expense linkage, which we talked about that one. That is a good one to bring up because a lot of students struggle with that one. So the key there is you set up the equation that we're talking from a cap-in standpoint. So we're talking about someone who has a portfolio, a well-diversified portfolio. So if that well-diversified portfolio include the insured and the insurer, they're both in your portfolio. The math we did is there's no way that equation makes the stockholder better off. The insured buys insurance, that becomes an expense for them, becomes a revenue for the insurer. That's a wash. The insurer hires people to manage that product. That's expenses. That's what I mean by expense leakage. That hurts you. No, you buy a mutual and it includes Chubb Insurance Company and IBM, and Chubb insures IBM. So the question is, you as a stockholder, are you better off if IBM buys insurance? And the answer is there's no way you can be better off because IBM pays the insurer. So in your portfolio, you're looking at your portfolio, there's revenue going from an expense for IBM and revenue for Chubb. That's a wash, right? Your portfolio is no better off than that. Chubb hires people to manage the IBM account. That's an expense. That's leaving your portfolio, right? You can't make money on that. IBM has a claim. That's a loss, but they get the insurance. But then Chubb pays the insurance and hires people to adjust it. That's what I mean by expense leakage. Chubb is hiring people to manage this product. Everything you do in your portfolio is left pocket, right pocket. It's either revenue or expense, claim or non-expense. The only thing that's not left pocket, right pocket are the employees the insurance company hires to manage that business. That's all money leaving your portfolio because it's an expense. So that's what I mean by expense leakage. A lot of students just say, oh, and there's also the expense leakage issue. But you gotta explain it. So that's the way to set it up. You're talking about 2 publicly traded companies. They're both in your portfolio. There's no way any transaction can happen between those 2 entities and you as a stockholder get any benefit from it. The only one benefiting are the employees that hire to manage that. because everything that happens there is a benefit to one and a detriment to the other, and vice versa. All right. Everybody understand that one? I talked about it quite a bit in class, so you might have to, that might be a good place to go back and look at that lecture again, because I actually went through a math example on that one. And then 4 reasons to still buy insurance. You know, you got that list there. There's other stakeholders, there's tax reasons, there's, well, the other stakeholders, you could actually break that out into different groups. We talked about the administrative side, the outsourcing side, the helping smaller businesses get some credibility kind of thing. So there's a list in the notes that give those. Most students do pretty well on that. A few students are a little too summarized on that. Don't overly summarize it. Don't say tax reasons. You know, give a little bit more discussion in that, but they're in the notes. It may seem completely foreign right now because you haven't started studying yet. When you start studying, it'll start coming back, and you can always watch the class lectures as well. All right, so there's the exam. So where do we go from here? So we're going to get into a pretty controversial topic. This applies to both homeowners and auto, but it has been a much bigger issue for auto. More people complain about it with auto than they do for homeowners. It's an old issue, but I love it. It's kind of like the mold issue. It's an old issue, but I can't think of another issue that's similar to it that is as insightful as it is. It really gives us a great insight into the actuarial process, how actuaries think, how they do their jobs, to try to be fair, but also to make sure the company is taken care of. So auto, you know, we have an exam, so you can actually get away with not reading the entire papers here. You can actually get away with just reading the highlighted sections in these articles. So in the miscellaneous, there's three articles: credit scoring, Article 1, Article 2, and Article 3. The way you should start it is the first 2.5 pages of Article 2 first, then Article 1, then the rest of Article 2, and then Article 3. Right? So we're going to start with this one. So we're actually going to do a lot of this in class. So if you skim through it on your own, you'll probably be okay for the class. So this is a letter written by Jose Montemayor. He's spoken to this class twice. I probably should contact him again. So what did y'all say? He was in his late 60s, right? Someone said that. I thought he was older than that. Maybe he would zoom in with us. I think that'd be pretty cool. He's a really great guy. I have 2 students this semester whose last name is Montemayor, but neither one of them are related to him. How smart is this guy? He has a quant background, so he's not an actuary, but he's quantitative background. But to become insurance commissioner, he had to have a CPA, and he didn't have any accounting. So he studied for the CPA and passed it. Just like that. I mean, that's a smart guy, right? So very talented. The industry loved him. He was a very kind of industry pro, kind of friendly to the industry kind of guy out there. So he writes this letter back in 2005. So this is pretty old, but it's still extremely amazingly current. Writes it to the governor, to the lieutenant governor, to the House, Texas House. Why did he write that? Well, because the Texas House was getting all these complaints about credit scores in insurance. And so the Texas House required by law a study to be made of this and done by the Texas Department of Insurance, the TDI. And so Jose Montemayor, he was the insurance commissioner for the mold case and for credit scores. So he got the 2 biggies. And so that's why he was such a wonderful person to talk to in my class, because he had it. He remembered it in detail. He just said some amazingly interesting things. What does he believe about credit scores? Well, what he says in this letter is not exactly his truth. You know, he's a little bit more adamant. So I'll tell you what he really thinks versus him writing a letter to politicians. But the real key to this is first of all, so there's a few things that are just obvious how you organize this. This is an exam question for the second exam. This used to be a paper for the class, and I switched it from a paper to an essay. And I'll give you a very detailed rubric on this one. This one's actually probably easier than the mold one because it's just pretty obvious what to do. But this study was commissioned to answer two questions, and then the answer to two questions raised a third question. So it needed to answer three questions. Two were answered in the first study. The third one was answered in the next study. So what you need to know is what were those questions. Let me just type them out first so you can just make it really obvious here. I'll do it from scratch just so you can see from scratch what we're talking here. So very precise. So the first question was, is there a relationship between credit scores and claims? And then the question related to that, frequency and or severity. Do people with low credit scores file more claims than people with high credit scores? Do people with low credit scores have higher average claims than people with high credit scores? That was the first question. The second question was, is there a disproportionate impact on the use of credit scores? So here the question is, to whom? Right? Obviously, there's a disproportionate impact on people related to credit scores. That's pretty obvious, right? People with low credit scores are harmed. People with good credit scores are helped. But what about men versus women? What about young versus old? What about different races? What about different ethnic groups? So that's the one they're going to ask. And here's what we're going to ask. We're going to have three types of discrimination. We're going to start with that. One of those is called disproportionate impact. But it's possible disproportionate impact could be interpreted to also be one of the other discriminations. There's three discriminations. Two of them are illegal. One of them is legal. Disproportionate impact is legal unless it is so blatantly a way around the other two legal ones than it would be. And so you're going to see how Montemayor, he actually has this wonderful sentence, very alliterative sentence that he uses. So that's that question. So that was phase one. Then phase two is this concept of, is credit scores strength simply reflecting other variables that are less controversial? Is it possible, let's say, okay, credit scores, yeah, they predict claims, but it's just because young people have bad credit scores and older people have good credit scores. So it's not credit scores, it's age. So let's don't use credit scores, let's just use age. So a better way of saying this is, do credit scores, in addition to other variables, still add additional predictability? Is credit scores helpful in predicting claims over and above every other factor you could possibly have? Driving history, age, where you live, where the house, where the car is, garage, those kind of things. Any guesses on the answers of these? This first one, is there a relationship between credit scores and claims? Yes. Is there a disproportionate impact that would be awkward? Yes. Race is the one that we're going to talk about the most. That's the one that has the biggest controversy. If you take credit scores and add all these other factors and see if there's any additional information, what do they find here? Yes, and what word do they use? Significant. That's Jose Montemayor's word. It provides significant additional information. So it's not a small thing, it's a huge thing. All right, so race is the biggest one. We know age as well, definitely. They also looked at income and a few other things. You know, it would make sense income would be related. You would think income are related to credit scores. Although something I think is amazing is the number of really wealthy people with bad credit scores. They do exist. It's kind of hard to imagine that they're out there. And this is the amazing thing. Rich people with bad credit scores drive worse than rich people with good credit scores. Right? So another thing we have to think about here is this issue of causation versus correlation. Are they the same? Not the same. So is the insurance industry saying getting a bad credit score causes you to start driving worse? They're not saying that. They're just saying there's correlation. Do actuaries care about causation? Maybe a little bit, but the wonderful thing about causation is it makes it less politically sensitive. Most people don't mind that young people, y'all might mind, but most people don't mind that young people pay more for auto insurance than older people. Because we know, especially young men drive really horribly. Although I'm going to show you the Canadian driver is a female and she drives pretty horribly, but she's young as well. Young people drive worse than older people. Most people are okay with that. Most people are fine that people who get a lot of speeding tickets pay more for insurance than people that don't. It's credit scores is the one is why does my credit score tell you about my driving? And what we're thinking here is there's another factor credit scores substitute for that we cannot get. What might that factor be? It might be personal responsibility. Now, if you don't have a good credit score, I'm not saying you're not a responsible person because there's reasons people have bad credit scores that they can't control, you know, just bad things happen. But there's probably is a relationship between credit scores and personal responsibility. Very responsible people probably on average have much better credit scores. And there's probably a relationship between driving and personal responsibility. People who are very personally responsible probably drive better. But how do you go out and get people's personal responsibility? Where would you get that data? You could ask them. You ask Americans if they're above average or below average drivers, 80% say they're above average drivers. Well, that's probably not true, right? I know I'm probably below average driver because of I don't have great peripheral vision. I'm willing to admit it, but you know, if the insurance company asks me, I'm going to tell them, I probably should strike that off my video. I'm going to tell them, yeah, I'm a great driver. Yeah, I'm a wonderful driver. So there's no way to test that, but if credit scores is a substitute for that, that's great. Then the other issue is false positives. Is it possible there are people out there with bad credit scores that are wonderful drivers? Absolutely. And what are we doing to them? We're overcharging them for insurance. But that's true with a lot of things. Are there young drivers out there that are wonderful drivers? Absolutely. So false positives is an issue. The other thing we're going to talk about is not in these articles, and that's possible workarounds. And this would be a wonderful paper 2 topic. Anybody think of how can we solve this? A young person has a bad credit score, but is a wonderful driver. Do we have a solution for that person other than just charging them more for insurance? Telematics, yeah. Is telematics the solution to this issue? To the false positive issue, I'm specifically putting these together. It's not a solution for the person with a bad credit score that's a bad driver, right? But if you're a young driver, you have a bad credit score, maybe something happened, you co-signed on a loan and you shouldn't have done it for some significant other, and now your credit's just been destroyed, but you're really a responsible person and you're a really good driver. Telematics, you put something in your car and it shows that you don't do rapid stops, you don't do jackrabbit starts, you don't speed, you're not changing lanes constantly, you're actually a fairly decent driver. Yeah, that may be the solution. And that's why I like that company Root. So it'd be a great paper. Root is it's an AI insurance company. So they use artificial intelligence to try to figure out how much to charge people. And they're a big user of telematics. I've been tempted to try this firm out. If you're interested in some paper topic, one thing I can offer you is there's a really good podcast on the insurance industry. I don't know if any of y'all have found it. I forget what it's called. I have to find it. It's on my phone, but they had one of their podcasts was interviewing a couple of actuaries from Root, and it was really, really interesting. It would make a great paper two topic. But that's what this company does. And so I've been tempted to try it out just to see what it was like. Is that them? Joinroot.com, that makes sense. So my understanding, I haven't actually tried it. My understanding is when you first start with them, the rate's probably going to be a little high versus where you can get otherwise. But then you put this contraption in your car, or you do it on your phone. They can have the phone there, but you do it on your phone. And as they figure out your driving personality, your rate gets adjusted down. And over time, if you're a good driver, and what Root's trying to do, I mean, this is what part of what they say. Their goal is that their insured base is actually really good drivers. Their goal is to not have bad drivers. That sounds like a pretty good insurance company, right? So their goal is to actually have good drivers. I don't know how they handle the joint underwriting associations, those kind of things, and when they're getting assigned bad drivers, but that's their goal. And so you go to Root. Initially, you're going to have a quote that's not going to look really good, but if you are a good driver, you should get a really, really good quote that could possibly be much lower than you could get from anyone else. But USAA has telematics, other companies have telematics, Allstate, so it's becoming much more common. The interesting thing with USAA is them trying to figure out how to adjust prices for it. How much can you actually rely on this information? Some people are using this for their teenage drivers. Parents want to monitor and know what their drivers are doing, kind of thing. So that might be a solution. There is no solution for the bad drivers with bad credit scores. They're just going to pay a lot for insurance, but it does adjust that false positive issue. So what we have to do is figure out these questions. So the first thing we need to do is get these 3 discriminations, and they're in this first article. The bottom of the first letter. To approach the development of a credit scoring policy, it is important to understand the distinction between unfair discrimination, intentional discrimination, and disproportionate impact. Now, I don't like these terms because I think they're backwards. I can never remember which one's which because I think they're backwards. You can let me know if you think they're backwards or not. Unfair discrimination, intentional discrimination, and disproportionate impact. So you don't have to worry about an exam. It's like, I don't need you to understand what's unfair, what's intentional. But one of these is you discriminate against a protected group. What? So you can't charge one race of people more than another race of people just based on the race. Even if you can prove one race drives worse than another race, you can't do that. That's illegal. And isn't that how you spell against? Oh, I have it in twice. Against, a protected group. And the other one is must have data for rate differences. An actuary can't say, I had this aunt, she had red hair, and boy, I couldn't stand that lady. We're going to charge people with red hair 50% more. Can you do that? Only if you had data that shows that redheaded people drive worse than all other people. If you can't show that, that's illegal. So which would you think is which? What is unfair discrimination? What is intentional discrimination? Without looking at the letter, what would you think? Unfair discrimination is what? Is that discriminating against a protected group, or is that not having the data? Yeah, I would agree with that. We'll see if it is. I still can't remember. I can never keep it. Right. So this would be no data. Let's see in the letter. Unfair discrimination to be the unequal treatment in individuals of the same class or hazard. So this is no data. So what is this one? This is the protected group. So, all right, so Lindy's on my side. I think they got it backwards. Yeah, to me, unfair. I mean, it's not fair to charge someone based on their race. Intentional sounds like, you don't have any data, but you're just gonna do it. So I don't think the terms mean. So I don't worry about that. It is important to know that there's these two things, right? Discriminate against someone because of something that, even if you can prove they're worse drivers, you still can't do it because they're a protected group, versus you don't have any data. Anytime you charge one group more than another group, you have to prove it with the state that that group actually deserves because of frequency or severity. And then disproportionate impact just means some people pay more than others in some group. And Mayor is going to make the obvious point. All insurance has a disproportionate impact. That's the nature of insurance. If we didn't want disproportionate impact, we would charge everybody the same no matter what. There would be no underwriting. We would just, everybody comes in charging the same rate. So the question is disproportionate impact from credit scores really intentional discrimination, but it's hidden behind credit scores? In other words, is someone's credit score a perfect predictor of their race? Let's say we have green people, and green people are worse drivers than purple people, all right? And we know that, so we say, we're gonna charge green people more than purple people, and the state says, no, you can't do that. That's illegal. But then we discover green people all have low credit scores, and purple people all have high credit scores. And we say, oh, that's why we do use credit scores. That would be illegal. If credit scores perfectly predict what group you're in, that's a protected group, you cannot do that. However, if green people with good credit scores drive better than green people with bad credit scores, then you're okay. Even though green people may have lower on average credit scores, as long as within their group, it's still predictive, then you're okay. Because you're not using credit scores to predict what group they're in. It's, within the group, it's still fair. And so that's what they have to decide. And I forget the exact term he uses, but let's find it because it's great. There it is. I love this phrase. You could actually quote this in your answer. Credit score has earned the outward appearance of being a surrogate for something sinister. Isn't that great? All those S's in there. I mean, I don't know if he wrote that or not. But a surrogate for something sinister. What is he saying is credit scores are being used to predict someone's race without telling them you were using it to predict race. And credit scores will not predict races. There are a lot of people in all races with great scores, and all people in all races with bad scores. And within those groups, the good score people drive better than the bad score people. So he's a good writer, or his staff is a good writer. All right, so he says, underwriting or rating classifications are not unfair, though, if they are actuarially supported. All right, so that's the unfair discrimination. It's when it's not actuarially supported. On the other hand, overt classifications or discriminations based on race, color, religion, national origin, or intentional discrimination are prohibited by law, regardless of actuarial support. Now, what's not in that list? Age is not in that list. How many companies in the United States can discriminate based on age? Well, you can give senior discounts, I guess. That's discrimination. What else is not in there? Gender. How many businesses can discriminate based on gender? Where you have ladies' night at the bar, maybe that's discrimination, who knows, but not too much. Huh? Oh, well, maybe, but if they could be sued for that, right? I mean, there's certainly, if you can find some way that it's intentional. But yeah, insurance, you can discriminate based on age, you can discriminate based on gender, not everywhere. There are countries that insurance cannot distinguish based on gender, which sometimes helps women, sometimes helps men. This depends on what type of insurance. Obviously, with auto insurance, not allowing for gender discrimination helps men and hurts women, so it kind of depends. So here, if women drive better than men, that is an intentional discrimination, but not by the law, because it's not one of those groups. So race, color, religion, national origin, those are the ones And I can't actually tell you if I know the difference in those, well, religion, obviously, but if I could distinguish between all those. Disproportionate impact is a lack of symmetry or unequal percentages. Disproportionate impact is an uneven distribution of each. So he's specifically saying, because the disproportionate impact obviously exists all over the place, but he says specifically, is there a disproportionate impact related to race? That's the one he's most worried about. Even though the distribution is not caused by one's race, it's caused by credit scores. Right, so that's what he's up against. The Texas Insurance Code does not prescribe a precise threshold or legal definition for determining disproportionate impact. Now, when he spoke to my class, when he brought up disproportionate impact, he says it doesn't exist. There's no such thing. I mean, he's like, it's stupid. We shouldn't be talking about it. So he was much more negative on it. And I think it's because of what he says down here. By the nature of risk-based pricing, all factors used in insurance have a disproportionate impact to some extent. So he's kind of like, why are we even talking about this? Obviously it does. One can make a convincing argument to ban the use of all risk-related factors used based solely on disproportionate impact. Effectively, I mean, even gender. It's possible certain races have a disproportionate number of women versus men. And so they're going to benefit because they have more women drivers who drive better. You know, maybe one race is 50.2% men and another one's 49.8%. You know, who knows? I mean, in China, what is it? 1.3 men to every woman or something? Isn't it something like that? So the one-child policy, I mean, it's 1.2 or something. I mean, it's a pretty skewed distribution. Well, in that case, then you would expect people from China to pay more for auto insurance because there's a disproportionate number of men than women's. You know, that would kind of make sense. He's saying, well, that's perfectly fine because it's not based on race, it's based on gender. So effectively, we ban all risk-based pricing, and essentially charge everyone the same price. That would be a setback to all Texans of all races, especially those of moderate to low income whose risk remains low. So this is the other argument they're making, and that's why I say these terms I brought up before are so critical. So we're talking about affordability, availability, adequate, and sometimes I say not unfairly discriminatory. Availability. So these are the issues come up with. The insurance industry used to just focus on this first one. Adequacy. Are they charging enough? So that's the adequacy. Affordability and availability sound like they might be the same thing, but they're not. Affordability is poor can afford. So we're really focused there on the poorest people in the society. Can they afford this? And often, not only do they have less income to buy insurance, but often their insurance is more expensive because of maybe the crime rate where they live, or who knows, there's maybe because they have weak, lower credit scores. Availability is the insurance industry provides coverage. So the insurance industry actually says, if you focus too much on affordability, what are you going to kill? You can kill availability. If you tell us we can't charge more because it disproportionately hurts these neighborhoods, then we just won't offer insurance at all. So insurance industry argues that allowing us to charge more for people who we have evidence are worse drivers, it means we can make insurance available, especially to the good drivers. So that's their argument. There's good drivers in poor neighborhoods who have good credit scores, and letting us use credit scores means we can make insurance available to them. If you don't let us do that, then no one's going to offer insurance and they'll be completely shut out of the market. So that's the availability. And then not unfairly discriminatory kind of gets back to the race, and you can't price based on that. So those issues come up, it's kind of ignoring the unfair no data when that's in there as well. So his argument is you've come to me with this question. We did the analysis. If we had found that credit scores were unfairly discriminatory or intentionally discriminatory, we could have shut it down. However, if all we discovered was a disproportionate impact, I have no legal authority to shut it down. I cannot tell insurance companies they cannot use credit scores. Now, I don't believe this next sentence. He may not have written this, maybe his staff did. He sure didn't say this when he talked to class, but he says, prior to the study, my initial suspicions were that while there may be a correlation to risk, credit scores, value, and pricing underwriting was superficial, supported by the strength of other variables. It's that third question. Right? Yeah, credit scores predict losses, but that's only because they're correlated to age and gender and other things. So let's just get rid of credit score and we'll use those other factors. If this were proven to be the case, I would have had a legal basis to make the connection between disproportionate impact, intentional discrimination, and either ban credit scores or adopt an allowable rate difference of 0, meaning no rate differences due to credit scores. Essentially, he's saying you don't need credit scores. You got plenty of other factors. He didn't say that when he talked to you. When he came in and talked to you, he says, I knew credit scores predicted claims. It had nothing that over and above other factors. So he like going in, I knew that. So he's maybe either he didn't write this or he's kind of trying to soften this. The study, however, did not support these initial suspicions. Credit scoring, if continued, is not unfairly discriminatory as defined in current law because credit scores is not based on race, nor is it a precise indicator of one's race. And later on, he uses the term significant. Credit scores are a significant additional amount of information for predicting claims. All right, so this is a good introductory to this issue. So phase 1 was to answer those first 2 questions. Do credit scores predict claims? And are they disproportionate? Do they have a disproportionate impact? Then someone said, well, but other factors might predict it just as well. So the second study, which is what this letter is to, the second study is, do they provide additional information? So the second phase of the study evaluates if and to what extent credit score enables an insurer to more accurately predict losses when used in conjunction with other variables. That's a really key phrase. So here it is, the word significantly. Overall, the second phase indicates that credit scoring significantly improves pricing accuracy, even when, he probably should have put that even in there, even when combined with other variables predicting risk. He's the one that used the word significantly. He didn't say slightly or to some extent significantly improves. More so for auto than for home, but for both. Now, the study says they had a problem on the homeowners side because there was some noise. You might want to guess what that noise was. What was going on when he was doing this? There's some noise that caused a problem with the statistic. It wasn't related to the housing crisis. What else have we studied in this class? Not Katrina, but we talked about that. This is pre-Katrina because it's not 7, you know. No, we talked about mold, didn't we? The mold issue caused some really big statistical problems with this study. So they actually, in some places, are almost like, I'm not even sure there's much there here. So I'll let you know a little early because of the exam, but you can see where we're going on this question. So what we're going to do is the first question. This is called a unifactor model. Only one factor. How do credit scores do claims? And then we'll do a multi-factor model. And consider multi-collinearity. Is credit score working only because it's correlated to all the other factors? It's just a substitute for these other factors. So that's what we're looking at. And so we'll start with the first question. We'll look at some charts. It gets a little touchy in places, but hopefully it won't be too touchy. And then we'll get into the second phase. All right, I'll let you out. Boy, 10 minutes early, but it's cold outside. So